Well, if the word of the year is uncertainty, how do you trade that and how do you protect your portfolio? Joining us now, we got Troy Gayeski. He's the chief market strategist over at FS Investments. Troy, great to have you on here. We were just talking about this market being so uncertain right now. Where do you find conviction in this environment? Where are you the most convicted right now?
Yeah, I mean, step back, uncertainty, it definitely fuels a more difficult environment to make investment decisions. But, that's the whole reason why institutions and now wealth management platforms have been embracing alternatives, particularly the last, 15, 20 years for institutions, and more like the last 5 to 8, because in times like these, where you have not necessarily a bust like the pandemic period or 22, but certainly more heightened uncertainty, that's when you can look to alternatives to provide more consistent returns without all the wacky volatility and uncertainty. So, when we think of middle market private equity as an example, and we talked about valuation before, valuations have come in for equities, but the S&P is still about 21.3 times forward earnings. As your other guest highlighted, the Mag 7 and the NASDAQ is arguably one of the cheaper areas given the growth projectile now. But you're still paying a lot for growth. In middle market private equity, you're roughly at a 10.5x enterprise value to EBITDA versus around 17 for the Russell, for instance. And you're consistently getting about 10 to 12% revenue growth. So, back to the uncertainty, let's say the economy is a little bit slower than forecasted coming into this year for all the reasons you've discussed. 8-10% revenue growth still looks pretty good, which gives us a very high probability of achieving north of 15% EBITDA growth in securities or positions that are priced reasonably, particularly given that growth profile. So we're really bold up there, and particularly on the positions that are levered to AI and infrastructure growth, which is contributing to GDP at levels we've never seen. So we're fortunate to have positions that have exposure to that. That'd be one example. Another example would be private credit. Private credit yields are still very high. They're somewhere between the 8 and 11% range, depending on the strategy. The spread to risk-free or cash has expanded as the Fed has cut. And despite the fact that recession risk has gone up marginally, you still have a very benign default environment. So you're not going to give much of that income, if any at all, back from a recession-driven default cycle. Now, obviously, in a recession, defaults will go up. You'll give back some of that income. But it's a very attractive place if you're solving for low beta, low volatility. And again, don't want to tolerate all the whiplash action that's taken place in fixed income, particularly the last 5 years, which has not been a great place to invest.
And so, Troy, that's where I kind of wanted to follow based on your first answer here, because some of those areas are not perhaps assets that every single person would have that type of access level to. And so where are some of even the public equities, even if we did continue to see chop and volatility in what a lot of economists have anticipated in a growth scare, but overall still seeing growth over the course of this year in the economy? Where are those public equity plays that you're looking across and saying, okay, it's still good to have some type of exposure?
Yeah, and by no means are we arguing that people should go away from asset allocation. You shouldn't abandon equity exposure. The U.S. is still the greatest economy in the world. Fortunately, from everything we analyze, will continue to be for a variety of reasons. So to the point we're discussing, if you look across markets now, I think a few things jump out. One is, again, I'll talk more broadly about the NASDAQ. The NASDAQ right now is about 18% more expensive than the S&P. But you're getting about 42 to 45% more earnings growth. So that's a very different environment than, say, 21 or even through Q3 of last year. Furthermore, if you look at the Russell, that's an area where you still have, we think, overvaluation relative to fundamentals. The Russell, the actual revenue growth in a very strong nominal GDP environment has only been around 2 to 3%. So you've been getting about half the revenue growth. Over 40% of the companies don't make money, and it's actually valued more expensively than the S&P. So to the point you were making regard to Mike Wilson, we don't always agree with Mike. Love Mike, he's fantastic. But in this case, it does look like tech has sold off more than it should relative to the fundamentals. And as you know, this is a tech-driven sell-off from the start, not only because of the extended valuations, but also the questions on OpenAI. And then once the tariffs hit, that's when you really had the plunge, and you started to see that rebound. That being said, we do expect markets to be much choppier, much sloppier this year. And we always thought you weren't going to get multiple expansion. Now that you've gotten some multiple compression, at least you have, if your time horizon's a year, 2 years, 3 years, you have potential upside to upside economic surprise or earning surprises.
So to what extent, Troy, do you think investors listening in on this should be exploring private capital markets as a diversifier in their portfolio? And I want to mention that Yahoo Finance just announced a tool where you can actually track all your private markets in our platform here. You can see that on your screen right now. You've got, of course, the likes of OpenAI and SpaceX at the very top of that list in terms of their valuation on the private markets here. To what extent do you see that as a great diversifier in this moment of volatility?
Yeah, so remember, when you're looking at alternatives, what you're solving for is above market income, above market total return. Not too hard to beat cash these days, barring a recession, not too hard to beat fixed income. And so last several years, obviously, equities have led. Alternatives have been a great diversifier. But in this environment, when you think about the evolution of the democratization, far more investors have access because in many cases, you can either be a credit investor or a qualified client to actually pursue these. So when you think of middle market private equity, you think of private credit. 10, 15 years ago, very difficult, if not impossible, for the average investor to access. Now, much easier. So again, private credit, you're throwing off 8 to 11% type income streams, very low betas, very low, if any, duration. Middle market private equity, you're shooting for, let's call it 11 to 14% type returns. Very tax efficient too, I should add to that, with, again, very low beta, very low sensitivity. And that's the whole key, is you build that exposure from 5, 10, 15, 20%. And some of the wealth management platforms now have about 30% targets. It buffers volatility in times of uncertainty. You don't have the bust, boom, bust, boom, bust, boom that we've had in equity markets the last 5 years, not to mention the last 25. And it helps clients achieve their long-term goals for compounding capital and also producing income in a very efficient way.